Thank you, and hello to everybody who has joined the call today. It's a pleasure to be here. It's great to have an opportunity to speak to you about Dunedin Income Growth Investment Trust, and I think that this presentation really does come at an opportune time. In the start of September, the board announced a new dividend policy for Dunedin Income Growth, which has led to a 34% increase in the dividend this year. And then for those considering the UK, it's actually been a very strong year for performance. The UK market's beaten the S&P 500 year to date. So, we'll talk about the performance of the trust, and whilst it has been challenging on a relative basis, I'll talk to you about positioning and why we think that our outlook is positive where we stand today. So to give an overview of the management team, Ben has been on the trust for 11 years, and I've been working with Ben on the investment trust for over 3 years now. But we're supported by an excellent team within developed market equities and over 10 investors who specifically look at the UK market. So great resource to be able to leverage those best ideas for Dunedin Income Growth Investment Trust. I want to leave you with 3 key messages today. So the first is to say that the investment approach that we have implemented at Dunedin Income Growth Investment Trust is to focus on quality and resilience. And you will see from the long-term performance of the trust that it does deliver long-term capital and income growth, but importantly, downside protection. And this is in both capital, but also in income, utilizing those benefits of the investment trust sector to grow the dividend of the company for over 43 years. The investment proposition is also differentiated. So we operate in the UK equity income investment trust sector, which is quite crowded. And on average, those companies mostly invest in value companies. But what you will see from the proposition that we're presenting is that we have a differentiated view. It is a highly active portfolio, 32 holdings, and we're focused on quality. So it could make a good complement to other value-oriented trusts that you may own. And then finally, the enhanced dividend policy. I want to talk to you about that today. The dividend yield on the shares as of today is about 6.5%, which we think is attractive versus cash and versus the FTSE All Share for investors looking for income. And the policy is for progressive dividend payments in the future. So turning to more near-term performance, we've got our highlights from our interim report, which has been published with performance to the end of July. And I think what you'll see is that, whilst it has been a volatile time in markets over those 6 months, actually the UK market has delivered a very healthy return of over 7% in those 6 months. The portfolio did outperform during that risk-off environment around Liberation Day and kept pace with the market. But in July, in the last month, the performance did lag the benchmark. Just want to check that the volume's okay, that people can hear me all right. Great. So I'll just carry on. So yes, so unfortunately, July was a more a challenging month for performance. And I think I'll explain the performance for 2 reasons. So for the first element is that quality, which is that investment style that we follow, has been out of favor for some time now. And what we've seen is that the concentration of returns in the benchmark, which is the FTSE All Share, has been heightened. So the chart on the right-hand side shows the contribution to returns for the FTSE All Share over 6 months to the end of July. And you'll see that it's really 3 sectors that are dominating performance of the benchmark. It's aerospace and defence, banks, and tobacco. So highly concentrated returns to that market. And these are sectors which we are not overweight. We don't have exposure to aerospace and defence or tobacco, and we are not overweight banks. And so that has been a headwind to performance. If you were to look at what's happened to quality as a factor during that 6 months when the market was up about 7%, the MSCI quality index was only up about 2%. So I think that shows that quality as a factor really has been a tailwind for performance during that period. In terms of the stocks, we've had a number of positive contributors. So Assura, which is the healthcare REIT, received a bid from its peer Primary Health, and it was part of a competitive process there. So that business has now been taken over. Prudential delivered good results with accelerating net profit growth, which supports that investment case. And finally, M&G announced a distribution deal with the Japanese insurer Daiichi, which was taken positively by the market. And then on the negative side for that 6 months, I mean, not owning aerospace and defence has been a key detractor, with BAE and Rolls-Royce delivering very strong performance during the period. But then on top of that, our holdings in Novo Nordisk and Azelis did disappoint. And on reflection of those investment cases, we did take the decision to exit both, where we believe there are lots of alternative options out there for us. So we chose to reinvest the proceeds. I want to give an overview of the portfolio. So as I say, it is an active portfolio, 32 holdings, which means that there's a high active share. It is differentiated from the benchmark. But what we're looking for is to be selective in those holdings, and we're looking for high quality companies that deliver resilient income. So you can see from the portfolio that the return on equity of the portfolio is higher than the benchmark, reflecting that stock selection, and also in general, the balance sheets are healthier for the companies in the portfolio compared to the benchmark. We invest across the market cap spectrum, so we're looking at mid caps and small caps too, and we do have an overseas element of the positioning. So 17% of the holdings are in European companies, and really what we're trying to do here is to get exposure to unique businesses and sectors which you can't invest in the UK, which are particularly compelling. So that's helpful to be able to add additional diversification to the portfolio by tapping into some of those European companies. And as I mentioned, high active share, high stock specific risk, and the outcome is that the dividend growth of the portfolio is superior to the benchmark. We also have a sustainability approach, which means that the portfolio's carbon intensity is almost half that of the benchmark. So whilst that was a focus on more near-term performance, I wanted to sort of step back a bit and reflect on more longer-term performance. So in January 2016, the board took the decision to reposition the strategy towards a total return approach, away from a high yield and value approach, which many in the sector are focused on. And since that point, the portfolio's NAV return has been in line with the benchmark. But I think you can see from that graph on the left-hand side, it has been less volatile at times too. And the focus on that capital preservation and resiliency is really something which has come through and can be shown on the right-hand side. So you can see that on average, when there's a down market, the portfolio does outperform. And this is certainly something that we saw during the COVID pandemic, but also this year during Liberation Day. So it's that focus on capital preservation. This also translates into income preservation as well, and you'll see that the income delivery of the portfolio is very different from the benchmark, and it means that in times such as COVID, the portfolio does deliver more resilient income than what has been quite a cyclical income delivery of the FTSE All-Share. So as mentioned, it is a crowded sector, the UK equity income investment trust sector. So what makes Digit different? Well, there are a couple of things, but I think, one is to say that on average, the sector does congregate towards high yield companies and value stocks. And what we're doing at Dunedin Income Growth is we're looking for total return, quality businesses, which can deliver growth in capital and income. So it's a different style proposition. We're also investing down the market cap spectrum, where we see more scope for fundamental research to add value to the investment process. So we do have an overweight position to the FTSE 250, which is the mid-cap index, for example. And also it's a highly active portfolio. So 32 holdings, high active share. It is not replicating the benchmark. But we do that because we think that that is the best thing to deliver returns for shareholders over the long term. Now, the quality investment style has performed over the long term, but that's not to say that it always performs. And we do recognize that quality as a factor can cycle in and out of favor. Indeed, can other styles too. But our focus on quality is based on evidence that over the longer term, it does outperform the index. It doesn't always outperform though. So that style leadership is cyclical. And I think what I'd point you to is that the most recent underperformance of quality really has been exceptional in its depth and duration. And I think we believe that we are closer to a turning point from a style perspective. In terms of the outlook then, where do we go from here? So as mentioned, that quality factor has outperformed in the UK over the very long term. And whilst it's been difficult from a performance perspective on the near-term basis, we believe that we're closer to a turning point and that can return. Why is that? Because the companies that we're investing in are in structurally growing markets. They have got a strong competitive positioning and resilient financials, which means that they can navigate different environments. And so if we were to see some slowing growth, or we were to see some slowdown from an economic perspective, then on a relative basis, the companies in this portfolio should deliver on a relative basis. And we also see good value within the portfolio. So I've been looking at the valuation premium that you pay for that quality, and it really has compressed over the last couple of years. And I'll show you a slide on where we are from that perspective. But I think you're not paying extra for quality at the moment. And then finally, we've done some bottom-up work looking at what our expected returns are on a stock-by-stock basis in the portfolio. And we believe there's a compelling opportunity to deliver superior returns in the future from investing in the portfolio. In terms of that valuation then, as mentioned, the portfolio does invest in quality companies, which means that on the right-hand side, you can see the portfolio has a superior return on equity to the benchmark, operating margins, and better balance sheet strength. But the PE multiple of the portfolio has been consistent over the last 3 years. In contrast to the FTSE All-Share, which has seen a material re-rating in the valuation. So it's gone from under 10 times PE to now just under 14 times PE. So whilst the benchmark has re-rated, actually the portfolio multiple has stayed consistent, which means that premium you're paying for quality has compressed to now it's only just over 5%. And we think this is an attractive place to be hunting for quality companies which are undervalued at the moment. Now, turning to the dividend policy. So as mentioned, there was a one-time step up in the dividend this year, 34% increase, which went to 6% of NAV. If you look at that on the share price, given the discount, that's about a 6.5% dividend yield on the share price. And there's been a commitment made by the board to continue a progressive dividend from this point. The rationale for that change, well, we know that income is important to investors. It's an important part of the total return profile for the company. So we want to continue that. But we're also looking at what's happening in the market. And there's this shift in corporate behavior away from paying dividends and towards paying a mixture of dividends and buybacks. So the buyback yield on the FTSE All-Share is just under 2%. And that's not being, so when you're looking to try and grow your income from the dividend payments of the companies, that's becoming increasingly difficult when companies are looking to opt for buybacks over dividends. So we're sort of reflecting that as well in the policy. But we also want the dividend yield to be attractive to shareholders. And we recognise that the yield that you get on government debt now or on cash is attractive versus history. And indeed, the dividend yield on the FTSE All-Share is just 3.6%. So in order to be attractive to shareholders, we want something which is going to provide you an enhanced dividend. So as I say, that's 6.5% currently on the share price. And that's supported by the investment trust structure, which, given the age of Dunedin Income Growth, is over 150 years old. There is a healthy supply of revenue and capital reserves, and this will allow the board to be able to pay that dividend through different parts of the cycle. This is the longer term track record for dividend payments for the trust, 43 years of growing or maintaining the dividend. This is supported by the capital reserves, the balance sheet of the trust, and we also do have 11% gearing, which is about in line with the market, which also supports that long-term performance. Taking a look at the top 10 holdings then, I think you'll see that the common denominator here is that these are generally very, very strong businesses, leaders in their industry, and quite different from the benchmark. And the way that we think about positioning is we think about the portfolio in two buckets. So you've got the majority of capital, about 70%, in quality compounders. These are high quality businesses which are delivering resilient growth and deliver high returns on invested capital. That's about 70%. So whilst the dividend yield on that portion of the capital is lower than the benchmark, those companies do typically deliver a superior dividend growth. But then we do have a portion of the capital invested in high yield companies, which have got a superior dividend yield. But we really do kick the tires on these names to make sure that we've got a high degree of confidence that those companies can pay that dividend. So a company like Chesnara, which is a small cap acquirer of closed-end life insurance books, that company has a 20-year track record of growing its dividend. It's recently made an acquisition too, which will allow that company to continue that dividend track record. So those are the types of businesses that we're looking for within that high yield portion of the portfolio. Two names that I wanted to highlight to you, which you probably don't see in many UK income portfolios. One is Softcat. They had results this morning, actually. So that is a value-added reseller of IT hardware and software to SMEs and government in the UK. They just delivered 17% growth in their operating profit last year. So they're benefiting from structural demand for technology solutions, but they really help SMEs understand what solutions they need and help source them for those businesses. It's highly cash generative, very strong returns, and it distributes all of its earnings basically in the form of dividends. So today it had a 10% increase in its ordinary dividend. And then Sirius Real Estate is an interesting real estate business operating in the UK and Germany. They focus on business parks and industrial assets, and they look to enhance the value of those assets by improving the occupancy and rental growth too. The company has been on an M&A spree, has been acquiring assets. It really sees now as an important window for them to be able to go and acquire assets and an important part of the cycle. So that's a company which has been very active from an M&A perspective, and that should support the ability of the company to grow and pay a growing dividend. On a bottom-up basis, we also look at what our expected returns are for the holdings. So this methodology is quite simple. It's looking at the free cash flow yield and earnings yield of the companies and putting in what we think is a relatively conservative view of the long-term growth for those businesses in order to get a view of an implied annual return for that company. And from what we see there, we think that the portfolio's implied return is at a healthy premium to what has been delivered by the FTSE All-Share over the last 10 years. So this bottom-up work really does give us confidence in the prospective returns of the portfolio. And then finally from me, just the outlook and where we are today. So I think, hopefully I've communicated to you that the Dunedin Income Growth has got a differentiated offering with a focus on quality, which whilst over the near term has been a headwind to performance, we believe that it's positioned for growth in the future. And given where we are within the UK equity income sector, it actually provides something that's differentiated and maybe a good complement to other holdings. The enhanced income policy is attractive to shareholders, and we're benefiting from that investment trust structure to be able to pay that superior dividend yield versus cash and versus the FTSE All-Share. And finally, we think the valuation of the portfolio is attractive. That premium you're paying for quality is really compressed, and if you combine that with the discount that the trust is trading on, which is about high single digit to NAV, we think that this is a compelling time to be looking at Dunedin Income Growth Investment Trust. So I'm very happy to take questions.
Okay, Rebecca, thanks so much indeed. Really interesting. And of course, obviously being mostly invested in the UK market, many are looking at this UK market thinking, crikey, we're already undervalued against many metrics anyway. So the headwinds are obviously there to be seen. Let's just pick up on a couple of quick questions if we can. Talking first of all about the main gauges of quality. You mentioned quality in the presentation. Can you explain a bit more about the gauges that you use for quality when looking at investments?
Yeah, so we apply sort of 5 strands to our analysis of quality, and we rate every company on each of these elements and then overall. So we're looking at the industry dynamics. Is there growth in the industry, the structure of the industry? Does it make that an attractive place to be operating? Then we look at the company itself and its business model and its moat. So has it got a sustainable competitive advantage? And that's important because if the company is generating higher returns, it needs to be able to, in order for that to continue, it needs to have a sustainable advantage, which will stop others competing that away. We look at the financials of the business. So we're looking at metrics like cash generation, the balance sheet strength, the profitability, also the resiliency of the earnings through the cycle to get a sense about how, the quality of those earnings. We're looking at the quality of management. Are they disciplined at allocators of capital, and do we have confidence in their ability to make the right decisions to create shareholder value? And then finally, ESG and sustainable is part of our assessment of quality, and that's part of our view in terms of the sustainability approach for the trust too. So we're looking there, what are the key risks that the company faces and what are they doing to manage those ESG risks?
Yeah, you also mentioned the fund performance against the benchmark, and this is obviously a very common way of measuring things. A more scientific way is to take a look specifically at the target tracking error, which came up as a question. This is a standard deviation, isn't it, between the fund's performance and the benchmark. Do you have a more granular analysis of how your performance has been going?
Yeah, I mean the tracking area that we target is to be, I think it's sort of 3 to 8% is a target that we have. In terms of the volatility of returns of the performance, I think you'll see that in periods where the market is down. So we had that slide about performance during down markets. On average, the portfolio does outperform in those periods. So it does typically sort of lag in rising markets, but then outperforms in those down markets. And so that's that quality approach coming through and the defensiveness of the positioning. And that's really something that we're looking to try and deliver for investors, because we do know that that's important for investors, that capital preservation element of investing.
Yeah. Also, you mentioned the fact that the fund is based mainly here in the UK. One question is, as a UK manager, would you like to see companies return more via dividends and share buybacks? This share buybacks issue has been around a long while now, as the company's preferring to use that as a way to potentially give investors more value, but doesn't actually really help them in terms of income, obviously. Does that play into your stock selection process? Good question.
It is a good question. I think my preference would be for companies to be investing in their business. If they think that they can generate a superior return from investing in their business because they are operating in an attractive market and they've got sustainable competitive advantage, then that would be our preference. If they don't, then and they're looking to distribute capital to shareholders, then we would again be looking at sort of what are the returns that they can generate from a buyback versus investing in the company as well. So if a company is trading at discount to NAV, so for example, some of the house builders are trading at discounts, the banks, they are doing a lot of buybacks as well. These businesses, if they think that they are able to generate a return from investing in their own shares as opposed to investing in other businesses, then that's something that we're happy with as well. And I think the new dividend policy actually makes us a bit more agnostic to that, whether it's a buyback or income, because we're sort of separating out those two elements in terms of being able to have that increased flexibility from the new dividend policy.
Yeah. Look, we've got the budget coming up, of course, at the end of November, 26th of November. One question is, how does the state of the UK economy impact your allocations? Again, much talked about in the markets. People I've talked to are constantly asking about this and about how it affects investment decisions. What are your thoughts on where the economy is, the headwinds, and what's happening? And of course, as I say, the investment arena ahead of that budget at the end of November.
Yeah. Well, I mean, it's certainly a highly anticipated budget. I was speaking to some house builders this week, and they are seeing the autumn selling season for UK house building being muted again this year, as consumers are, cautious about potential tax increases or changes to policy there. So it's certainly having an impact in terms of consumer sentiment and business sentiment too. In terms of what we expect, I mean, I think if you look at the valuation of UK domestic businesses versus the market, they are discounting some pessimism around the outlook. I mean, the FTSE 250, which is a more UK domestic index, is now trading at a premium dividend yield to the FTSE 100, which is very rare because typically 250 companies deliver superior growth to the more mature businesses in the FTSE 100. So I think that is systematic of this caution that the market has around UK businesses. So my hope would be that the budget will be a clearing event and will allow investors, but also to the consumers and businesses to sort of move past it and then get back to their what they want to do, that pent up demand for housing, for example, to come through. So highly anticipated, certainly something we'll be watching closely.
Would you go down the market cap spectrum to look for investors? How far down? What is your smallest holding?
In terms of market cap, it's probably about 300 to 400 million. We will go down the market cap spectrum. That's one of the benefits of the investment trust structure, that you have that closed-ended vehicle. And we see lots of opportunities within the mid-cap space, given that valuation opportunity. So really resilient companies. We've got companies like Genuit in the portfolio, which does plastic piping for construction and for housing. These companies are discounted and not pricing in a recovery. So we see it as attractive hunting ground for new ideas.
Yeah. Another question is about UK stocks. How tied are you to this UK market? And what proportion of non-UK stocks would you be allowed to buy if there were attractive opportunities elsewhere? It goes back to this thing about waiting for the budget to find out what the environment's going to be like for investments here in the UK. But do you have a rule to follow? You are mostly UK stocks, of course. But are you persuaded, could you be persuaded to expand the allocation of non-UK listed shares in the portfolio?
Yeah, the policy set by the board is that up to 25% of the NAV can be invested outside the UK stock market. Just again, sort of reflection that the UK stock market is not the UK economy, and only about 75% of the revenues of the UK market is outside the UK. So it is an international index. So we can go up 25%. We're currently at 17%. And I think that reflects that we just see lots of opportunities in the UK where there are discounted ideas. And so that we're spending more time probably looking at, our watch list is UK companies at the moment, given that valuation.
Yeah. Okay. One final question has to be about the general trend at the moment, the headwinds in the UK economy. Your thoughts on where things are going? We've got a Bank of England interest rate meeting, of course, next month, as well as the budget. Thoughts on how things are for us investors looking at opportunities?
So I think the UK economy is growing, but it's growing sort of about 1% or just over 1%. Inflation has been sticky, and that has caused concern for investors. But when we speak to our economists, they are still forecasting quarterly interest rate cuts from the Bank of England, which would be supportive in terms of some easing for businesses and for consumers too. Certainly we're certainly sort of, there is some growth to go for. So it's not all doom and gloom.
Yeah, just one final question that's come in. Do you have an active discount management policy? Got to ask that. Got a couple of minutes left. Just quickly.
Yeah, there's a buyback ongoing for the trust, and that is to support the discount.